Guys, JC Peretz here of allstarcharts.com, and I thought I'd take some time on this beautiful Tuesday afternoon to take a look at some charts that are on our mind. Last night we had our monthly conference calls, our strategy session, where we go over the monthly candles, because not only do those, help us zoom out and focus on the underlying trends, it really gives us no choice. We have to zoom out and analyze the underlying trends with those monthly charts. So let's dive in a little more into the nitty gritty. I wanted to talk about small caps, emerging markets, what we're seeing in bank stocks, and then take a look at some steel stocks at the end. So let's start with the smalls. This really, to me, tells the story of what the market has done for the majority of the year, really since February, when the NASDAQ advanced decline line peaked, when the IPO stocks peaked. There was a lot that happened in February, including small caps and micro caps both stopped going up, and it's really been a chop fest ever since. And what we've seen is fewer and fewer new highs, more new lows. Look at micro caps, fewer new highs, more new lows. So things are not just getting less good, they're also getting a little bit worse. Even the short-term highs, no new highs in small caps, or very, very few. Same thing with micro caps. And then when you look at the new low list, we're getting expansion there. So it really just is a messy market. Not that you really need the breadth internal data to just look at the chart and just be like, yep, these things are a hot mess. So the question becomes, okay, is this a consolidation within an ongoing uptrend? Because let's remember, this small caps peaked 6 months ago, but think about where they came, right? So they crashed in the COVID crash, came back last fall, back and retraced 100% of that, and then extended through that into the first quarter of this year. So, you want to talk about a well-deserved digestion of gains and consolidation. We've certainly seen that. So is that what that is? And now small caps can resume their uptrend and continue higher? Or is this more of a distribution pattern? Really, that's the question. So in the meantime, what we want to look for are the stocks in the small cap space that are showing the most relative strength. Because when that selling pressure, when that supply finally gives way, the ones that were holding up the best, or quote unquote bucking the trend, if you will, tend to be the leaders once the overall market resolves higher, if it does. So I think one way to play that, we call this the minor leaguers, because what we're doing is we're scouting the farm system for the next mid caps, right? We're scouting the farm system for the little guys, the next ones to get called up to the mids, right? And if you ask any of the old timers, they'll all tell you some of the biggest winners ever, or a lot of them, came from the mid cap space. So we like to stay, try to stay one step ahead of the game here. So we're looking at stocks between $1 and $2 billion before they graduate into mid-cap status. And that's this week's list. And one name that I think stood out from that list is Road. So this is Construction Partners. It's a $1.7 billion construction stock, breaking out on a relative basis. That could perhaps be the leading indicator for this stock. Nevertheless, we only want to own Road if we're above 35. Below 35, that still puts us in this range. So we don't want to be too aggressive, because we don't know when the selling pressure is going to let up. We don't know when this is going to resolve higher, or even if it is. So if we're not above 35, then we got to assume that we're still stuck in this range, and we only want to be long if we're above that. And I think $49 would be the next target. So I really like the risk reward there. And then just getting back to the small caps, is this a distribution that's going to resolve lower and be a great short, or are we ultimately going to resolve higher? And this is really just a consolidation within an ongoing uptrend. That's really the question. So, all right, part of that small cap space, you're going to get a lot more financials exposure in small caps than you are in the large caps. And so regional banks, small caps, they've been dancing together, struggling together. Regional banks just really being the culprit there. So here we're looking at support right around 64, 65. Support in February, March, April, again in June, once again, and then we broke, right? And this broke coming into July. And now we're back to the scene of the crime. I got to tell you, if regional banks are able to get back above 65, I think that would be incredibly constructive. Rates are probably heading higher. Small caps are probably not going down. That's really what I'm looking at. So 64, 65 on regional banks, KRE, that's a big one for sure. But let's remember, where has the strength been? It's been in the large caps, right? It hasn't been in the small caps. You can see it in the CME. You know, when you look at financials, kind of just struggling overall over the last several months when they peaked in May. Regionals peaked in February, but the large caps peaked in May. Look at CME Group just pushing up against those highs. 212 for me is a big one. If we start taking out 212 and holding above that, I think we can own CME. Below 212, leave it alone. But above 212, I think CME's CME is a buy. Also, keep an eye on the market access. Is an $18 billion company, so it's a fraction of the size of CME. Part of those exchanges and broker dealers. 600 is the level. We're stuck below that. We're nowhere near there, so it still got some work to do. I'd rather be a buyer above 600, and if there's a resilient strength in the broker dealers and exchanges, it's probably going to trickle into some of the smaller guys. So we want to look for a buy on a breakout above 600. So in the meantime, we'll stay patient. Look at Carlyle Group, a $17 billion asset manager, just absolute beast, to show you that there are winners in the space. There are winners in the overall market. While it tends to be messy at the index level and the internals are messy and not many stocks are working, there certainly are stocks that are working. Look at Morgan Stanley. This one comes from our Young Aristocrats report, which are stocks that have raised their dividends every year for between 5 and 9 consecutive years. Morgan Stanley got on that list, has been a big winner. Moving forward, we only want to be long Morgan Stanley if it's above 91. If we're below 91, leave Morgan Stanley alone. Make it somebody else's problem. It's not for us. Above 91, I like it, with a longer term target up near 143. Robinhood, nice IPO. Tweeted this out today. Nice base over the first few days. We got that breakout above the IPO, which we talked about last week. You know, if we're below the IPO price, you know, it's guilty until proven innocent. But if we're above that, then, you know, obviously sky's the limit, right? That's the base. The old saying was, and then this is what it looks like now. So just a stair step higher so far here, you know, but the way I learned it is that pre-IPO, think of that as the base, and then the IPO itself is the breakout. So if you abide by those guidelines, then as long as we're above those IPO highs, even the closing of that first day, you know, pick your poison depending on how you want to manage risk. But if we're above those levels, I think we need to be long. This is our Follow the Flow report. I wanted to bring this up because it does include a bank. So Follow the Flow, we're looking for unusual options activity. And not just any unusual options activity, but specifically big, large, aggressive, directional bets by institutions in the options market. And then we create the list, right? These are both longs and shorts. And listen, any idiot can create an option scanner, you know, that scans for unusual activity. Like, that's the easy part. The real magic is then going into that list and hand selecting the best opportunities from either the long side or the short side. That's the real magic, not just creating some random scan. That's the easy part. Hand selecting the best names, that is where I think that, you know, sets us apart from the rest. We create the list first. All that is a universe. And then we dive in, and we're seeing a potential turning point in financials. And if that does occur, you're probably going to see that trickle over all over the globe. So we're looking at ING Group. Let's call it 14.25. If we're above 14.25, I like it long with a target near 20. Below 14.25, leave it alone. It's not for us. By the way, if you're interested in these slides, email info@allstarcharts.com. Make sure to use the password small and emerging. I give presentations, or I give a presentation in India this morning, for example. So if you want to make sure to get the right deck, email info@allstarcharts.com. Make sure to use the password small and emerging. And then here's all the European banks combined, right? That $20 level on the EUFN. If we're below that, it's suspect, as it has been. But if regional banks are going to get back above 65, and then European banks, this particular index fund is above 20, now we're starting to fill up the check marks for the bulls, and I think that would be incredibly constructive. So we're looking at it there. And then just zooming out, look at Germany going back 12, 13 years. Monster base. This is the Germany ETF, EWG. A breakout above those 07 highs, which are also the highs in 2018 and the recent highs this summer. If we're taking those out, man, I can't think of many things that are more bullish than that. Moving over to emerging markets, where has the struggle started, right? Because the struggle is real in emerging markets, right? Where is that taking place? At the former highs from financial crisis. So at a very logical level, we're going on 6-7 months of churning here for emerging markets. And like regional banks, getting back above those 2018 highs, right around that 65 level, emerging markets, same thing. Look at those 2018 highs. If we're back above those levels and regional banks are back above those levels, wow, I think that would be super constructive for this market, most definitely. And then just showing you some of the culprits here. China certainly near the top of that list, not just in terms of weakness, but in terms of weighting in the EEM. So that's huge. And I do have some good news for you emerging market bulls out there. The Economist, in their infinite wisdom, comes out with a magazine cover that says dashed hopes, emerging markets growth problem, and then a rainbow going into a trash bin. So, you know, that's pretty creative. Probably took them a while to come up with that and, you know, get the magazine cover approved and all those things. That takes time. So usually by the time all those things happen, it's probably not near the beginning of that trend, but the trend might just be exhausted. We've seen it in the past plenty of times. So, you know, we're looking at emerging markets on a relative basis here, and then emerging markets ex China on a relative basis, just showing you it's been a disaster. And even the Economist magazine got wind of it. You know, very few things for emerging markets can be as bullish than the Economist being bearish of emerging markets. That's how I see it. So here are the all-time lows. You know, I think we're probably gonna need to squeeze very soon. You know, as Marv Albert used to say, a kick, save, and a beauty. That's what we need right now, a kick, save, and a beauty for emerging markets. But I think there's your catalyst with the Economist coming up with that magazine cover. So I think it's interesting, you know, but in that emerging market space, if you're gonna be in that space, to me, I think you wanna be in the base metals, because like in that whole conversation, base metals have really stood out. Relative strength, copper pushing up against those highs, and CRB index just absolutely ripping. Notice how both of these, when you zoom out, look very similar to one another. So copper breaking out of a 15-year base, what does that mean for the CRB index? I think higher. Look at steel absolutely ripping. If you're looking for the home run in the base metal complex, steel has just been relentless. Look at tin making new all-time highs here on the tin futures. So going into the stocks themselves, here's a $22 billion building materials company, crushed stone, sand, gravel products, concrete, asphalt, things, just heavy things, rocks, steel, iron ore, tin, aluminum, copper, all of these things doing very well. Martin Marietta, MLM, if we're above 350, I like it long. Below 350, you leave it alone. Above 350, I like it long. I think 500 is next. Look at the metals and mining ETF, XME, above 44, that's a long. Below 44, then it's suspect, because now we're back below those 2014 highs. But above 44, I think you gotta be long. Here's a closer look, right? There's that level. 44 was support, right? Former resistance in 2014, turned into support a couple months ago, and now back above that. So above 44, gotta be long the space. Look at the steel index. 56 is the level there. Above 56, I like it long. Target of 78. And then of the steel stocks, listen, one thing we know about new all-time highs is that they are not a characteristic of a downtrend. Ternium here, we're looking at a $9 billion steel stock from Luxembourg. Gives you a lot of global exposure, manufactures and processes steel products in Mexico, Argentina, Paraguay, Chile, Bolivia, Uruguay, Brazil, the United States, Colombia, Guatemala, Costa, Honduras, El Salvador, and Nicaragua. So you're getting a ton of global exposure from this steel company in Luxembourg. It's a mid-cap, technically, for now. When it graduates to large cap above 10, which it looks like that's coming, 46 is the level. So if we're not above 46, we can't own it. 46 puts us above those former highs from before the financial crisis. Above 46, I think you got to own it. Target up near 71. Just a lovely ADR from Luxembourg. So, guys, thank you so much for being here. If you are interested in the slides, make sure to email info@allstarcharts.com. Make sure to use the password small and emerging. Email info@allstarcharts.com. Password small and emerging. I am JC Peretz of All Star Charts. Ping me on the interwebs on Twitter, StockTwits, Instagram, YouTube, and Clubhouse @All Star Charts. Thanks, guys.